Good afternoon and welcome to today's webinar with Netwealth. So today we're going to talk about financial planning. My name is Tom Kimchi and I'm the Head of Advice at Netwealth and a Chartered Financial Planner, and I'm joined today by Fred Smith, Associate Client Advisor here at Netwealth. And today we'll be talking about different areas of financial planning and specifically how that works at Netwealth. So an important topic always, but particularly now with change of government coming up potentially, and lots of complex rules that have moved on quite a lot recently. But today we're going to start by talking about, first of all, financial advice. What is it? Why is it important? When might you need it? And why might you need it? We're going to look specifically at what advice can cover, what it covers at Netwealth, some things that we don't cover. We're going to talk you through some case studies that look at specific planning points, but also some cases where we've helped clients in particular ways. We're going to look at some advice areas and common pitfalls, and also specific rules that you can take advantage of yourself. Of course, we'll talk about the Netwealth charging structure, we'll talk about our process, we'll talk about possible next steps. And of course, there will be personal follow-ups. So some of you will know us already, and you've already spoken to us, so you'll have a point of contact. But if you don't, we'll put a link in the chat so you can click on that, book a meeting with us, and we'll be very happy to discuss your circumstances, your plans, and how we might be able to help in person with you. Also, more generally, if you do have any questions, there's an email address you should be able to see on your screen, advice@netwealth.com. So any simple questions, feel free to fire those away to that email address as well. I'm going to start by passing over to Fred, who's going to start by talking about financial planning. What is it? Why is it important? And when might you need it? So over to you, Fred.
Thank you, Tom. And thank you all for joining. Good to see a full house. Some of you, so we already know, and some of you I can see have already taken advice, so it's great that you're tuning in as well. So what we want to talk about today is financial planning and advice at Netwealth, how we can help, why it's beneficial, and what might you need it for. So sort of help you get started there. So firstly, what is financial planning? Why is it important, and when might I need it? So financial advice, in simple terms, in a nutshell, it aims to boost the effectiveness of your long-term planning. So what we do, we'll analyze your situation, we'll consider your objectives, your circumstances, and your needs, and we'll analyze that to provide clear personal recommendations for you to improve your situation, but both now and in the future. Really, it's about achieving your long-term goals in a sensible way, thinking strategically, avoiding mistakes, doing the right things, and being tax efficient. So it's evidence-based. We're navigating the market for you, taking into account all of the different tax and regulations, and really help you have a plan that can deliver for you and give you that confidence that you're making the right decisions, and you can achieve your goals over time. So why it's important, just to quickly show this chart. Some of you may have seen this before in our investment seminars, but really it's just to understand, how we can help you think of a plan and think about your asset allocation. So a lot of people hold quite a lot of cash. A lot of people are quite worried about entering the market, particularly when there's volatility. I just wanted to show this very quick chart to show why planning is important, because as you can see here, the darker line is cash. Over time, cash will erode in real terms of value because of inflation. And investing, why are we investing? It's because we're aiming to beat inflation, really, or at least sort of keep up with inflation. So this is just to show you that it may be the case that over this sort of 15, 16-year period, cash does at the beginning, when the interest rates are high and markets are falling, beat investing. But if you missed the moment when you wanted to re-enter the market when markets were going up again, and even if you came out of the market at the wrong time or enter the market at the wrong time, you would have missed out on a lot of growth, and ultimately you'll be sort of £50,000 worse off in real terms. And this is just a balanced portfolio, fairly moderate risk. So working with an advisor can help you make that decision around how much cash do I hold, how much risk should I be taking, when should I be in the market. And this next slide kind of emphasize that point as well. So this is the S&P 500 since 1987. Again, being in the market is so important. So working with an advisor to navigate that process, having the right asset allocation, being in the market, not making reactive decisions, i.e. moving into cash when markets are falling and you want to protect your wealth. This is a common something that people want to do, and it works sometimes, but it's very hard to get the timing right. So if you moved in 1987 and if you just left the money in the market the entire time, didn't worry too much about the downs, and some of these downs are quite big, 50, 60%, in times. So some of them very steep. They look here in COVID, very steep. So it can be very concerning. But working with an advisor can help you have that confidence that staying in the market is the right thing. They can explain to you why that is, help you make the right decision. So if you're working with an advisor here, it may have been the case that you did stay in the market the entire time because the advisor gave you the confidence to do that, and sort of helped you on that journey. But if you were a bit reactive and moving too much, into cash, out of cash, changing your portfolio too much, if you're worried about things falling, and you missed just 10 days in that journey, you would have had only 1,450% return in that time. I say only, it's still a great return, but you would have missed out on a lot of the return in that time. That just highlights the importance of being invested and working with someone to help you on that journey. So why might I need advice? So it's really about planning your spending and saving to meet key goals. And that can be a targeted piece of advice. Maybe you've inherited some money, or you've had a life change, a promotion, looking to retire, or consolidation, whatever it might be. And you could do, a targeted piece of advice. Say, look, I've got this money, I want to invest it. Or you can do a holistic financial plan. We think the holistic financial plan, though, is a great thing for most people to do because it gives you a long-term plan to work towards. But also a targeted piece of advice is also very useful in key moments, and we offer both at Netwealth, so we have that flexibility. Understanding the investment landscape is also very difficult. There's a lot of products, there's complex regulations, the tax treatment changes very regularly, so understanding that can be complex, and a qualified advisor can help you do that to make sure you're using the right product for you, whether that's an ISA, whether it's a pension, whether it's a general account, offshore bond, different trust structures for families, what's the best way to hold your money, and how to draw from money, and which tax allowances to use on an annual basis. It can be quite tricky, so we're here to help do that with you, and that can really add value. Also, just a peace of mind. Make sure that you're doing the right things, you sleep well at night, and you've got your plan, and you're not second guessing yourself. Did I miss this? Did I miss that? People can often read a lot of financial news and think that they're missing out on something, or they have an idea, and they can check that with their advisor and they run that by them. So peace of mind, I think that's something that's really, really underrated. And all of our clients are very happy that they've got that, and that you're making the right decisions for you, your family, your grandchildren, and ultimately to meet your own goals. There are two main types of advice and two categories. I think this is important for people to understand. We do ask this a lot. So Netwealth is a restricted advisor. The other type of advisor is independent. It may be the case that it's not really that one is better than the other, they're just different approaches. So most wealth managers in the UK, at least by AUM, so assets under management, are restricted, which means we keep things in-house. So Netwealth has an integrated model. So we run our investment portfolios and we build those from the whole of the market. So the whole investment universe is available to us, but our investment team, and we have a very strong investment team here, is making those decisions on your behalf to make portfolios to try and get the best risk-adjusted returns for that level of risk. So we're making those investment decisions on your behalf, which means we're restricted. We're also providing our own ISA, general investment accounts, and pension products. So again, we're not going to be recommending a pension with a different provider. We've already done the research and we've selected a provider that we think is going to be the most efficient, low cost, and meet our needs. So ultimately, we're recommending our own services. That's what makes us restricted. An independent advisor is doing the same thing, but isn't necessarily doesn't have to recommend the same product every time. Doesn't have to recommend their own investment solution. It may be they don't offer investment solution, so they have to outsource that, and that may mean that they use a different discretionary manager. Someone like a Netwealth, we may sometimes offer our services to other advisors. They may be using a centralized proposition. And they can change what they're doing from time to time. They may also offer a slightly wider set of services, potentially something more niche. But ultimately, both approaches are offering the same thing. It's offering financial advice. It's just a different journey. One of the other aspects of independent advice, which I think is worth highlighting, is that in practice, it's not always as independent as you might think. Generally, advisors have relationships which they have over time, which they like to keep. And in practice, most people then who are their clients tend to go into the same types of products and investment strategies. And we think one of the benefits of being restricted is that we're controlling everything ourselves. We're not reliant on too many third parties. We can be flexible, we can be quick, we can be efficient, and generally the restricted approach tends to be slightly lower cost because everything's integrated and everything's being dealt with by one person and one place. It can be the case that with many different third parties, things can be slower and difficult to get information and more expensive. So we just prefer the restricted approach, but ultimately it depends on what you prefer. So we offer two types of financial advice. So the first is one-off advice. This is a single report in a specific area, and we will agree the scope of advice and the fee beforehand. So it's based on £200 per hour. A typical report might be anywhere from, if it's a very short report, an investment piece of investment advice or a transfer recommendation, and then an investment advice, a few hours, let's say. A more extensive holistic report might be 12, 15, 16 hours. Just depends on the complexity, number of accounts you have, what you want us to do, how much modeling. So that's and then what we do is we'll give you that recommendation or that plan. We can help you implement it, but ultimately the ongoing management and reviewing is down to you. We do, of course, have the flexibility at Netwealth to do a one-off piece of advice regularly. So some people want to do a one-off piece of advice, and 2 or 3 years later they come back, they do a refresh, just to make sure everything's still suitable. And also with the one-off advice, there's no obligation to transfer your account to Netwealth. So, for example, if you are a DIY investor and you're using a platform such as Interactive Investor or something like that, there's no need. You can take advice from us, and be confident using chartered financial planners and very well qualified financial planners, and we can help you with an asset allocation and explain what to do in a long-term financial plan. But you can continue to manage that yourself on your preferred platform. So you don't need to move to us if you don't want to, although we would always encourage people to do that and then let people know how they do it if they want to. Often the case, people take one-off advice and they do end up moving to us or moving to ongoing advice. So we have that flexibility. Ongoing advice is more holistic. So we'll offer an initial financial plan. It's based on 0.35% per annum, and that is levied on top of the investment fees, which Tom will come on to later. And this gives you all the initial work and 2 formal meetings per year. So every 6 months we will meet. But of course, we're also on hand to provide advice at any point. So as your circumstances and needs change, we're there with you on that journey. And we're being proactive and we're reviewing your portfolio, making sure everything is still suitable. So when might I need advice? So important life events are key. So say lump sum, some people get inheritance or a windfall, a new career or promotion, a bonus, getting married. Then you might want to think, okay, we need to be a bit more serious now. Getting divorced, can also be a big moment for people, and lots of financial questions there. Having children or grandchildren, retiring, excuse me, it's probably the most common area we work on. As you can imagine, people accumulate a lot of money, and as they're approaching retirement, they tend to want to get a good financial plan in place to make sure that they can achieve what they want to over retirement, which nowadays could easily be 25, 30, maybe even more years. So it is very important to make sure you have a robust plan for that. And gifting and inheritance tax planning is also a big area we work on. Often it's just a question of modeling, or giving people their options, how to gift in a tax efficient way. Can they afford to gift? You don't want to gift money to someone, a child or something, but then you find out you're running out of money down the line. So taking advice and really modeling and planning for that is very important. While you're working, you're likely to have some surplus income, particularly as you're approaching what you might call peak years. Often people are earning about their peak earning years between the ages of 40 and 50, or up to their 60s. So it's usually the point when people are working the most and they've kind of reached their peak, and then they tend to be at that peak until pretty much close to retirement. It may be the case that you're starting to have some surplus income and you want to make sure that you're investing that in a smart way. It's just about using your tax allowances, making sure you're doing pension contributions, getting the most tax relief that's available. There's a number of things to think about with pension contributions that you can carry forward unused allowances from previous years. You may be tapered. It may be the case that there's an optimal amount that you can contribute to get the most tax relief, such as getting your personal allowance back, but bringing your adjusted income below 100,000. Whatever it might be, we can help you do that in the most efficient way. And so taking advice on that can really add value over the long term. Also, just making sure you're investing with the right level of risk. I think this is also a very common pitfall that people make. They either take too much risk at the wrong time and they don't have the time horizon to do that, or they take too little risk and they're 20, 30 years away from retirement and they're in a cautious portfolio. Working with an advisor might give you the peace of mind to take a bit more risk because we can show you why that's sensible. So just having that knowledge to help you can be important, and also just a coherent plan. Nowadays, people move around a lot. Work-wise, it's not uncommon for people to reach retirement with 4, 5, or even 6 different pension pots. And consolidation, having a coherent investment plan, having the right strategy, reducing costs, making sure you are using your ISA allowances. Maybe you and a spouse have different tax allowances, tax positions. Making sure you're using everything appropriately is really important, particularly at those key life events or approaching retirement. So I'd say they're the 3 big ways where you might need advice, but there's also so many more. And if you are thinking about it, do give us a ring, send us an email, book a call, and we can sort of understand what might be sensible. And if you do or don't need advice, we can always help there. So what advice might cover? So it's about reviewing your circumstances and analysing it, risk profiling and asset allocation, making sure you're taking the right level of risk, structuring consolidation. It might be pension transfers, it might be ISA transfers, just having everything in one place on the right platform and reducing fees and improving your administration and simplifying things. Being tax efficient, of course, is a key area. It's about investment growth and being tax efficient ultimately, two of the main things that we do with our planning. Drawing down in an efficient way, again, using those tax allowances when you're drawing down, something we'll come to on a case study in a minute. Bespoke cash flow modeling. At Netwealth, we have a really sophisticated cash flow tool which we built ourselves and which we're always improving. We find this could be a very powerful tool to help clients visualize their plan and their position and what's possible and what they need to do. Maybe that their target isn't achievable. So we can say, okay, what do we need to do with you to make it more achievable? What is achievable? Maybe it's very achievable. So, okay, what could you spend? Could you spend a bit more? Could you gift a bit more? These kind of questions we can help you with. And then inheritance and estate planning, also a big question. Of course, inheritance tax bans have been frozen for a long time. It's not as generous as it once was. Even fairly people with moderate wealth, if they've got a house, can fall into that. So we can help you structure in a way which is more efficient from that perspective, but also maybe things like gifting, and other things like trusts and bonds and other planning points to help you be more efficient with your estate planning. What we do not cover. So insurance is one thing we don't cover. We don't do tax compliance and tax reporting. We can't help you do tax return, although we can give you some sort of information, and define benefit pension transfers. Although we can help you model your pensions and compare your different options to help you have a more informed decision on how to take your pension or whether to transfer it. But ultimately, in all of those areas, we do have partnerships with people, so we can help you with insurance and annuities and stuff like that. We can send you to one of our partner companies, which we've selected from our own research, who are very good, and we can refer you to somebody who can do defined benefit pension transfers. So if you do have questions around that, do get in touch anyway, and we can point you in the right direction and also talk through the pros and cons and the various implications. And just very quickly, the benefits and the value of advice. So there is a lot of research on this. One of the most prominent pieces of research was from the International Longevity Centre, which was reported. They did research over a 5 and 10 year period on people who did and didn't take advice. And what they found was that people who did take advice after the 5-year period were £48,000 better off on average. The cost of the initial advice versus the increase in growth was 2,400% greater, so very much worth it for that initial cost. People might be slightly put off when they see £2,000 or £3,000 fee, but ultimately, if that helps you save tax and improve growth by a much larger number, then ultimately it is worth it. The pensions were much larger on the advised group and also the non-pension assets. Over a longer period, those who took regular advice, so ongoing advice with regular reviews and new advice as needed, were even better off, 61% better off than those who took no advice. So over a long time period, if you think about your retirement, getting to retirement with a robust plan, having had taken advice, you're likely to be in a better position. And I think that's really important, and ultimately it is about adding value. So you, in almost all cases, I would think all cases, you'll get more out than you put in from taking advice. And that's what the research shows. I want to go through a quick case study before turning back over to Tom. So this is a client, anonymized, but broadly. So Mr. and Mrs. Smith, wanting to retire in 12 months' time, have about £2.5 million in assets jointly, would like to spend £100,000 a year net from when he turns 62. Their key objectives are investing efficiently. They want to do a one-off large trip at the point of retirement. They want to give money to their children, and they want to do some renovations on a house. So they need to do a few one-off large withdrawals, and they also want to do some gifting, but also just make sure that their assets are managed appropriately and being efficient. So firstly, if you look at their initial asset allocation, they're mostly in equity, which is fairly natural approaching retirement, but maybe it's a bit too risky at this point in their lives, especially as they're looking to retire. It may have been appropriate to de-risk a little bit sooner, particularly if it coincided with a market crash. Having retiring this year or next year, they've had the crash in sort of 2022, but that's broadly recovered now, 2020 and 2024. But if they had retired a year ago, it may have been a different question. So it's definitely worth taking advice several years before retiring, just to make sure that you're not getting a bit unlucky with timing and there's a market fall, or if you are taking quite a lot of risk. So a quick review of their charges. The current IFA, and this is quite typical. This is not uncommon to see somewhere between 1.5% and 2.5% with an IFA or another wealth manager. So the first thing is, can we reduce those charges? And as we see, the all-in cost at Netwealth for somebody portfolio of their size is less than half of what they're currently paying. So it's already a big improvement. And if we can improve the investment strategy and reduce fees, they can keep more of their money. So we reviewed their position, we analysed the level of risk. We did do the transfer because it was saving on fees and it would improve their administration. We implemented a new investment strategy to take less risk overall and be more diversified. Because they're going to be drawing down, we need to be aware of things like sequencing risk, i.e. if there's a market fall and you're drawing income at the same time, what you're doing then is you're amplifying losses. So taking a bit less risk and having a more stable journey is often better than having a very volatile journey when markets are falling and you're taking money out. So we want to be a bit more stable when we're drawing income, but we want to be targeted. If there's an account or a level of assets which they don't need for their income, we can take a bit more risk with that. So that's what we did here. We took less risk with the accounts they're going to take income from initially, but more risk with their long-term assets and assets for inheritance. We looked at their pensions. We crystallized the pensions appropriately. Managing the tax-free cash is really important, and doing that a bit more smartly, you can really add more value. And we built cash flow models demonstrating what they could achieve. So we helped them go for our portfolios and look at what was appropriate. Obviously, the more risk you take, the higher the potential return, but the more risk of loss. So you do need to be quite nuanced around how you select that risk. And this just emphasizes that point. Over the short time periods, the risk of loss can be quite high, but over longer periods, that risk falls. So generally, with a longer time horizon, we can be a bit more bullish, but with a shorter time horizon, we might need to be a bit more cautious. So without ongoing advice, just setting up a plan with the right investment profile, a very strong position, 3.8 million remaining. You can see the journey here, taking money out for gifting and holidays. It's broadly falling. They've sold an investment property at this point after 10 years, and then it's broadly stable for the rest. So it's a very consistent and sustainable investment plan. At the end of the projection, though, they do have about a quarter of their wealth in ISAs. So nearly $1 million would be in ISAs still, and that's fully inheritance taxable. So you're talking about 40% of $1 million that will be subject to inheritance tax, like 400,000. So 3.8 million remaining, but quite a lot in ISAs still. But having taken ongoing advice and really managing the plan appropriately throughout and making changes, so using your tax allowances properly, not taking too much from the pension, crystallizing the pensions at the right time. So basically trying to pay less income tax and making sure we're moving assets into the more tax efficient accounts on an ongoing basis, we can improve that position by 600,000, so they've got 4.4 million remaining. The investment strategy is exactly the same, but what's different is the ongoing planning and the ongoing changes that we're making on an annual basis with the taxes. The final thing is this distribution of wealth. So instead of 27% being remaining in ISAs, we're talking about 2%. So instead of about 1 million and then 400,000 being subject to inheritance tax, we're looking at about 88,000 being left in the ISAs, so 40% of that being subject to inheritance tax, so only about 30,000 of inheritance tax versus 400. The majority then in the pensions, which is currently inheritance tax free, that can be inherited without tax. So that ongoing planning, crystallizing at the right time, keeping assets in the more efficient accounts can really add value over time. So hopefully that is quite a powerful chart. I'm going to turn back over to Tom now. Thank you very, very much for listening, and Tom will take the second half of this talk. Thank you.
Thank you very much, Fred. That's great. And I'm going to start by looking at another case study. If you just bear with me whilst I share my screen. So I'm going to look at something slightly more specific to begin with. I'm going to be looking at a case study around the lifetime allowance to begin with, which many of you know no longer exists. However, it's still relevant, I think, to illustrate the point and to highlight what happened in the past, because of course, when it comes to future planning, we just don't quite know what's going to happen. So let me quickly talk through this, then I'll talk through something that's somewhat similar actually to the lifetime allowance in terms of the way you apply for protection, and then I'll talk through some of the possibilities. So looking at the lifetime allowance, just for those that sort of weren't aware, the lifetime allowance was a limit to how much your pensions in total could grow to before you started to face a punitive tax charge. So the lifetime allowance increased from sort of 2006 to 2011. It peaked at about exactly 1.8 million actually. Then it fell down to 1 million and rose with inflation for a little while and ended on a figure just over £1 million. So where we have the lighter blue bars here, so 2011, 2012, 2013, 2014, and 2015, 2016, these were periods where you could apply for what's known as fixed protection. So typically a client would have been advised by their financial advisor, although of course they could have done that on their own, and they would have been advised to apply for protection from this falling amount. And the illustration or the example I give here is somebody who missed out on applying for fixed protection 2012. So let's say they were eligible for that. They had pensions worth 1.8 million or more in 2012, but they didn't apply for this protection. If they then waited until, say, 2022 and then crystallized their pension without this fixed protection, they would have missed out on about £800,000 of additional lifetime allowance. And that would mean about £181,000 less tax-free cash, that figure being 25% of the difference. So just by missing out on applying for this certificate, you could have lost out on quite a lot of tax-free cash. And you know, if you'd have missed out slightly later, or you'd applied for the next one rather than fixed protection 2012, it wouldn't have been quite as much. But it's just an example of one of those things that's good to stay on top of. Can be missed because it's not the sort of thing that becomes sort of a household name or that people regularly discuss around the dinner table, not necessarily the most interesting topic to most people, so easy to forget. But if you did have a pension that's valuable, then it would have been a really important thing to have. Which brings me on to the next point, and this is something that is relevant today actually. This is a very new piece of legislation following the removal of the lifetime allowance. And this is a transitional tax-free amount certificate, TTFAC, as it's sort of known in short. So this is a slightly more specific piece of advice that you may consider in due course, and it's for those that have taken pensions in the past, accessed their pensions in one way or another, but have potentially not used all of the tax-free cash they could have done. So if that applies to you, then you can apply specifically, consciously. It's not something that happens on its own. You have to make this conscious election for the certificate. But if you do so, you may be able to take more tax-free cash. And I give an example here where somebody is able to take £81,000 of additional tax-free cash just by being mindful of this and applying for the certificate. So we have here a case study, somebody called John who accessed pensions in 2014 and 2017. they had fit protection, so they had 1.5 million as their protected LTA. Just looking at the grey box towards the middle left-hand side of the slide now. They had a protected lump sum allowance, which is the maximum level of tax-free cash now of 25% of their LTA, which is £375,000. So by default, now moving into this tax year, it means their lump sum allowance, the amount of tax-free cash they can take is £375,000. And if we look at the table below that now on the left-hand side, we can see they accessed their private pension in 2014, the final salary pension in 2017, and they took £200,000 of tax-free cash from their private pension. That used 50% of their LTA at the time, and they took £400,000 in total via their final salary scheme, and that used 25% of their LTA. But they didn't take any tax-free cash from the final salary pension, and that's the key point here. If they had taken tax-free cash from their final salary pension, this might not be beneficial. And there are circumstances where it's actually not beneficial at all to apply for this certificate, and it can leave you in a worse position. So it certainly needs to be carefully considered. But in this case, because they didn't take tax-free cash from the final salary pension, the rules now mean that they might actually be able to take that from other pensions they have, if they have those pensions, of course. So moving to the right-hand side of this slide, we look at the deemed tax-free sum utilised. So from a total of 375, under the default assumption, they would have used £281,000 of their tax-free allowance. And that's because without the certificate, actually your final salary pension is deemed to have used some of that allowance, even though you didn't actually take it. So this is really why the certificate exists, so that you can prove essentially that you didn't take tax-free cash from the final salary pension. And this didn't used to be a thing before this tax year. So with when looking at the tax-free sum remaining, it means it's starting from £375,000. The default assumption would reduce that to £93,750. But with this certificate, actually you only take away £200,000, only the tax-free cash you did actually take, which means you can have £175,000 of tax-free cash. So again, quite a nuanced area, certainly won't apply to everyone. And as I said, very important to be careful and not just to blindly apply for it thinking that it can't do any harm, because it actually can. If you took tax-free cash in an environment where the lifetime allowance was higher than it is now, but you didn't have protection, you could actually put you in a worse position. So it does need to be carefully thought about. Of course, it's the sort of thing that when we're providing financial advice to clients, we will think about. But just an example there of quite an important thing that, again, hasn't really been discussed that widely outside of pension planning circles, so it is easily missed. Which brings me nicely on to later this year. Of course, there's an election very shortly, and as ever, it's impossible to know what's going to happen, and it's even very difficult to assign a probability to something happening, because often we're surprised, even when there are policies that are sort of very well signposted, they sometimes don't happen, and sometimes things come completely out of the blue. But I've listed here just some of the things that relate to financial planning that have been discussed, some more likely than others, of course. So we have VAT on private school fees. Of course, if that does come in, and you're paying private school fees or you're planning to, then that's going to make quite a big difference to how much you need to budget for that. So very, very important to adjust your plan, certainly, or to be mindful of that. There's often talk about pension tax-free cash being reduced, being abolished. Currently, as a general rule, it's 25% of your pension, which is really useful, and it means that you can plan around that. It might be that you plan to use that to clear a mortgage. It might be that you take it to top up ISAs or make a gift to your spouse. Lots of planning to be done around tax-free cash. So, of course, if that was to change, then it's really useful to have a plan about what that means for you. The lifetime allowance, so it has been abolished, but it could come back in. Labour said when it was abolished that they would reinstate it, but it's very difficult to think exactly how that would come back in. Now it doesn't exist at all. What would it mean for people that have crystallised their pensions? Capital gains tax is often talked about. It's currently much lower than income tax rates, so 20% for high rate CGT versus 45% as the highest rate of income tax. Something that could be changed. It could make quite a difference how much money you allocate to general accounts that typically pay CGT. Rent caps or rent controls have been talked about. Of course, only really relevant if you have a buy-to-let property, but many clients do when they're approaching retirement. If rent caps limits how much you can increase rent by, that can have quite a big impact on how much you need to drop in your pension instead to supplement that. And finally, wealth tax. Again, this sort of thing could come in many different forms. with no detail or anything like this. It's very hard to say how likely this is, but it is often talked about, often speculated on, and again, will certainly impact financial planning. So lots to think about there. Moving on to specifically the Netwealth advice process and how we help clients. Fred has touched on some of this, but before moving forwards and thinking about financial advice, financial planning for you, I think it's worth mentioning that all initial calls, all discussions are always entirely complimentary. So hopefully you have seen the link in the chat so that you can arrange one of these calls or meetings, but feel free to do that and we can discuss your options with you. But as Fred discussed, one of the first things to decide will be, do you want a one-off piece of advice or would you like ongoing advice? And I'll talk about this in a bit more detail shortly. But before I do, worth mentioning that whichever option you choose, you're not actually committed to sticking with that particular service. So a common scenario actually is somebody that opts for, say, a one-off piece of advice, and then decides, actually, I quite like that. And actually, I know that I've got a few events coming up in my life that I'd like to be advised upon, so I will convert that one-off piece of advice into ongoing advice. So from a client's perspective, it's a seamless transition. It just really means that you don't pay that one-off advice fee. Instead, you start to pay our ongoing advice fees. So that's very possible. Sometimes clients have a one-off piece of advice that sort of sets them up for retirement, say, and then they switch on ongoing advice later in life when they've sort of given up or had enough of trying to keep up with legislation and had enough of worrying about these plans themselves. So lots of different options. We certainly don't tie clients to a particular way of accessing our service, but worth having a think in advance what do you think is more likely to be better for you. And so what is the process itself? So the first thing, as ever, is a call or a video or a face-to-face meeting to discuss and agree the scope of advice. What would you like to be advised upon? What assets do you have? What would you like the advice to entail? So that's often the first point of discussion. Once we've agreed what we'd be advising you on, we send you an advice agreement that confirms that in our advice contract. We then typically request information from you. It may be that we have lots of information already, but there's often other assets outside of the purview of Netwealth that are very useful to us to know. I mentioned buy-to-let properties earlier. That's a good example. It could be directly held cash. And could be business assets. There are lots of examples, but we request all of that relevant information from you. We then discuss risk, ethical considerations, and any nuance relating to your objectives, because often we get an objective like somebody wants a certain level of income, but sometimes things are slightly more nuanced, and sometimes there's some flex in how much income you need at various stages of life. So it's good to flesh all of that out to make sure that none of that's missed when we're providing our recommendations. Once we have all of that, we begin work, and then we prepare and send to you our advice reports. And typically this is 40 to 60 pages. It takes 2 to 4 weeks, depending on complexity. And you can see a very small snapshot of an example report there on the bottom right-hand side. We send that to clients. Of course, it takes them some time to digest that report and have a read through. But then, of course, we present it to clients to make sure it's all fully understood, to make sure clients have the chance to ask any questions, to make sure we haven't missed anything as well, and to make sure that there aren't any adjustments that should be made. We'll take clients through our findings, and then, if appropriate, we help clients implement that advice. So certainly if it's with Netwealth, we can do that very easily on our online platform. It might be that you change risk levels following our advice. It might be that you actually enter drawdown, take some tax-free cash. It might be that you transfer between providers, typically transferring assets to us, but there could be other options as well. So that's a snapshot of the process. Of course, it doesn't always play out in exactly that linear process, but that's a pretty good general view, I think, of how it tends to work. And that process I just described there, which you can see on your screen, is the same actually usually for ongoing and one-off pieces of advice. So with a one-off piece of advice, the process typically ends here, unless of course you commission a new piece of advice. But with ongoing advice, once you've implemented your plan, then of course you have the regular checkups. So ongoing advice means every 6 months we meet to update your plans and provide new recommendations as appropriate, but also to talk you through what's happened over the last 6 months. So every 6 months we'll confirm values of your non-Netwealth assets and property directly held cash. And we'll of course update you on performance, we'll update you on what's happened with markets and where you see markets moving in the future. We'll also advise specifically on utilising any unused pension, ISA allowance, CPT allowance, and anything else that might crop up. Again, who knows what might be there in the future. If you're retired, if you're drawing income, if you're, say, later in life, then we'll give specific advice on that. So it's quite easy for us to say what we think you should do now, but again, it's hard to know how that might change in the future. So often we recommend clients use, for example, their basic rate tax bands, but it's hard to say how that might move in the future. We've heard today, albeit it's unlikely based on current polling, that the Conservatives win the next election, the quadruple lock for the pension, or the increase of the tax-free allowance so that state pension doesn't exceed that. That would be a nuance, and that would mean changing plans potentially, depending on how the ramifications looked once the legislation had formally come out. So that sort of thing would be taken into account in an ongoing piece of advice following a review. And of course, we always confirm risk profiles and investment portfolios remain appropriate, because again, what's appropriate now, if you're say 60, might be quite different when you're 70. And that could be because your circumstances have changed, but it also could just be because your feelings on markets have changed and you're just not so willing anymore to take risks. But that's why you need to check in regularly to have those discussions and see what the volatility on those portfolios mean to you. But although we meet every 6 months, as described here, that's certainly not the only contact you would have with us if you were an ongoing advice client. So we have those as a minimum, really, to make sure that things aren't missed. Typically, one is just before the end of the tax year and one is after. But of course, it could be that new and urgent legislation comes up that needs to be acted on immediately. It could be that something in your life happens that means that you need to make a decision immediately, whether it's a bonus has been received or you need to move house suddenly for whatever reason. So we're always on hand to have ad hoc meetings. It's just those 6 monthly meetings are a good minimum starting point. And of course, you just may decide at any point in time that you want to make a change for whatever reason. It could be that you want to make a gift to your children. It could be that you just want to change things around for another reason. And as I said, we're always on hand to have those discussions and provide the advice when clients demand. Moving on to fees, so what is the cost of this service? I've started here by showing the Netwealth fees. So I've included here our investment management fee because that is required to have the ongoing advice. And you can see it's a sliding scale for investment management, but the financial planning fee, the second line item in this table, is 0.35% regardless of the sum invested, which brings an all-in fee of between 1.4% and just under 1% depending on the sum invested. As I said, we do also offer one-off advice for specific fixed fee quotes, and you can see here we charge £200 per hour. And of course, how much we end up charging depends on the complexity of the advice. But rest assured, if you do commission a one-off piece of advice, you'll always know the exact fee in advance. So we'll give you a fee quote, and we will stick to that quote unless there is something extremely substantial that crops up, and then we'll always discuss that with you in advance before proposing to charge anymore. But a typical retirement-focused advice report costs typically between about £1,600 and £2,400. But again, it really depends on how many scenarios you'd like us to model and how many different pensions you might have and things like that. So, how to get started with Netwealth? What might the next steps be? So there are a few things to think about here. The simplest thing to say really is just the bottom point, actually contact us to arrange a time to discuss, and you have the link to book a call. And as I said, I think many of you will have a personal contact at Netwealth already, so just send them an email, give them a call. I'll be very happy to discuss with you these next steps. But before you get around to that, you might want to have a think about your assets and liabilities, your income and expenditure. And we can certainly help with this to provide context and to let you know generally what other people tend to think, although of course everybody's very unique and plans are very bespoke. Sometimes it is useful just to know what typically that people need before they retire, somebody in my sort of situation. But making sense of assets and liabilities, knowing what sort of state pension you might be entitled to is a really useful thing to start with. Think about your objectives, so not just your current objectives, which might be retire or downsize or sort of dial down how much work I'm doing, but think about how that might change in the future as well. Do you want to make gifts? Do you want to sort of have renovations done to your house and some fancy holidays that you've been planning for a while, or are you in a sort of steady state just drawing down a regular sum? So good to really think about what exactly might transpire throughout the rest of your life, albeit it's very tricky, and you'd always want to plan for uncertainty as well. But that's why we say, are there any alternative scenarios as well that you want to think about? Because we can model all sorts of different things. There's always a base case, which is the most likely outcome, but then it could be you want to model as downsizing your primary residence. It could be you want to model taking less risk or much higher inflation than we tend to consider. So all sorts of things can be modeled. It's really just what's of most interest to you and what's most likely. And the final thing here is just encouraging family members to join meetings, which is quite an underrated point, I think, when thinking about financial planning and the benefits of it. Often we find just how things naturally develop. It tends to be one person in the family that makes most of the financial planning decisions for the family. But we certainly encourage people to bring their spouse, bring their children, whoever it may be, to these meetings to assist with financial planning and succession planning, and just to make sure they feel comfortable that if anything was to happen to the main decision maker, first of all, they just know that somebody is managing things. They don't feel rushed into making a decision. And secondly, just for their own benefit, they have a better understanding of what's going on. They feel less lost. And of course, even without advice, the Netwealth tools make that easier than it might with other companies. But certainly planning, having that report to refer back to, knowing that an advisor is on hand to take you through things as long as it might take, with no restrictions on the access and no time spared in terms of getting people to understand things, it can be really, really beneficial just for peace of mind. So we're very happy to meet all kinds of family members as often or as little as clients want. So that's worth thinking about as well. So moving on to the summary, and apologies for overrunning slightly here, but financial planning with Netwealth, it can be suitable for those with complicated affairs. Again, as is quite obvious, if your affairs are complicated, you're more likely to need help with that. But often those with simpler affairs who aren't very confident managing things themselves or just don't want to waste significant sums of time managing themselves, keeping on top of legislation, can be very beneficial for them as well. Advice, as Fred discussed, can be provided on a wide range of topics, not limited to, but including saving tax efficiently, and drawing down tax efficiently. We focus often on asset allocation and risk, choosing the right combination of those to make sure you're most likely to meet your objectives. And estate planning is also a big topic as well. And the benefits of this, one of the key ones is providing peace of mind, but the financial incentive as well is for potentially larger returns due to tax savings, not paying as much tax as you might have otherwise done, and also larger investment returns potentially due to being in a more appropriate investment strategy than otherwise have been the case. Thank you very much for joining us today. Any questions at all, again, particularly simple questions, feel free to fire them through to advice@netwealth.com that you can see on the screen here. Otherwise, feel free to book a meeting. We'd be very, very happy to meet you and discuss your plans personally with you. Thanks very much. Enjoy the rest of your day.
Thank you, everyone, for joining. And hopefully speak to many of you soon.